This is a sessional meeting of the Institute and Faculty of Actuaries to discuss the interim report of the Equity Release Working Party. I would stress that the report, which was posted on the website Friday, is an interim report. It's still going a little bit through the peer review process, but given the topicality of this subject matter, we were keen to expose it to a sessional meeting at a relatively early stage and hopefully get a lot of feedback from you in the audience. I'm hoping this will be a relatively interactive and lively discussion. It's also particularly timely because, as I'm sure everyone pretty much in the room will know, this came out yesterday, which was a bit of a coincidence, but I think a fortunate one. It would have been probably slightly less fortunate to have come out 5 minutes ago then we would have been struggling to talk about it. So we've got quite a lot to discuss tonight. I've got 5 members of the Working Party to my right. They're going to basically present, I think, in order as they sit next to me on different aspects of the paper. So the rough running order tonight is about half an hour of presentations and then about 50 minutes, hopefully, for contributions from the floor and questions, which we can discuss with the panel. And then I'll wrap up at the end for about 5 minutes. So introducing the Equity Release Working Party, or 5 members of the Working Party. Tom, to my immediate right, is the chair of the Working Party. Is that correct?
That's correct.
Yes. He's also chair of the Life Research Committee, and he's a member of the Life Board and the Research and Thought Leadership Board. He co-authored a sessional paper in 2016 on the future of social care, Who Pays? In his day job, he's Director of Actuarial Underwriting at Just and the retirement lending business there, and therefore very heavily involved in the equity release space. Charles, next to him, is the Deputy Chair of the Working Party. He's Managing Director of Golding, Smith & Partners, a consultancy he founded in 2002, and he's been advising clients on equity release market for the last 15 years. Next along is Alex Mockridge, Capital Management Actuary at Legal and General Retirement. He's worked on equity release mortgages since 2013, all the way from pricing to assumption setting, restructuring and valuation. Raj Sword, next to him, is EY's Head of Actuarial in the South Western Wales. He's worked with ERM and various associated solutions across his career with both HSBC and EY since 2007. And then last and certainly not least, Scott Robertson, there's a typo on my thing here. He's the Head of Financial Management Group at the Phoenix, Head of Financial Management Group at Phoenix, one of obviously the UK's largest consolidators. His particular responsibility is the group's investment strategy for shareholder business and direct sourcing of assets. And his team have sourced 2 billion of private assets over the last 24 months, ranging from local authority loans to, you've guessed it, equity release mortgages. So a very competent and experienced Working Party, and I'll hand over to them to take us through some of the key elements of the paper. Excuse on the logistics with 5 people to hand over.
Cool. All right. I'm on. Good. Thanks, Paul. Thanks for the introduction. Good evening, everyone. So no presentation would be complete from the IFOA without the usual disclaimer. I think it's worthwhile reminding everyone that we're not talking on behalf of the IFOA necessarily, or our employers, for that matter. So we've kept the presentation this evening deliberately short, just to give you the chance to raise questions, give us your thoughts on the interim paper. We really want to get feedback on how it currently stands, and we plan to finalise it in Q1 next year, early Q1 hopefully. So I'll give you the background to the paper. I'll talk about why equity release is important and what the regulatory background is to this paper. Charles is going to talk about the no negative equity guarantee. He's going to talk about existing findings on academic research in relation to the equity release, and explain how firms currently model the no negative equity guarantees, what are the issues, and touch on possible solutions. Alex is going to talk about the valuation section of the paper, valuation of ERMs, draw out the key points from the paper. Raj is going to talk about structuring and securitisation of ERMs, and then Scott's going to talk about the credit rating of them. And then we're going to try and do an online survey, hopefully a bit more successfully than we did at the Life conference. So that just at that point, we'll ask you to switch your mobile phones on, otherwise we won't be able to do the online survey very well. And we'll just highlight what the next steps are for the working party. So I thought I'd just explain who the working party are. So there's about 12, 13 members from across the insurance sector, representing investors in ERMs, consultants to their clients that are investing in ERMs, whole range. So we've got broad representation, as Paul suggested before. We were set up towards the end of 2016. The working party has been predominantly working on the draft of this paper, but at the same time, it's been a very busy period responding to consultations from the PRA. So that's we've played a key role in supporting that, and we've also helped to set up the independent academic research that the IFOA and the ABI are currently commissioning, or they have commissioned, and it's currently underway. There's an independent review group that's managing that, with the ARC project managing it. So why is equity release important? Well, first and foremost, equity release is a socially important product which enables asset-rich, cash-poor retirees to use their housing wealth to supplement their retirement income. And there's a lot of it. There's about 1.8 trillion of 2.6 trillion of homeowner equity is owned by the over 55s in the UK. So there's a lot of housing wealth available. But before we get into the technical details of why equity release is important, I wanted to share a video that illustrates one example of how equity release can make a difference to equity release customers. Hopefully this will work.
I've lived in this house for 70 years.
And I've known David for 70 years also.
Yeah.
Since he was a baby in his mother's arms.
We hadn't spoken to David for a very long time. I got a phone call from Brian, his next door neighbour, who had been keeping an eye on him for all these years, saying that he was in a pretty poor state, he wasn't coping, and that he needed some help.
David hadn't done anything at all towards the maintenance of the house, so it was a complete wreck. The roof wanted repairing, the walls were soaked with damp, which was hazardous. We found an old address book, and we found Jean and Pat were the nearest to David.
He said he'd like to get in touch with social services, but as not being a relative, he couldn't. And would we be willing to get involved?
They were very willing, because they realised David couldn't cope anymore because the house was in a dangerous state.
First of all, the upstairs electricity wiring developed a fault. Then the water pipe had to be replaced.
David needed the whole house refurbished. He had no money. There was just nothing we could do. We actually thought he might have to sell the house and just go into rented accommodation, because the state of the house, he wouldn't have had enough money to buy anything decent around this area. We were in a fix.
We certainly were. Yeah, and we had sleepless nights about it. We've been in tears about it, because we just didn't know
where to turn,
what to do. And then, fortunately, you got a phone call.
That was a relief. Because I mean, not for us so much, but for David, because he's lived in this house all his life. Doesn't know anything else, he doesn't want anything else. And they just said that it was going ahead and that Legal and General were interested. We were very relieved when they said they would do it.
Yeah.
I think David's aware that it looks very nice now, the house. It's been re-roofed, replastered, and meeting up with his cousins again, Jean and Pat, has been very helpful to him mentally. We look forward to him living a good life from now onwards.
So yeah, there are plenty of examples like David's where ex release is making a real difference to people's lives. And I could have drawn examples from other providers in the market. Legal & General is one of them, obviously. But you're probably thinking there must be more to ex-release than the customer side of things, and you're right. Clearly, ex-release mortgages are an attractive, illiquid asset to investors. There's approximately $4 billion forecast to be invested in ex-release in 2018, earning an average gross yield of 5.2%, with a duration typically in the range 15 to 20 years. And it's estimated by the PRA that the additional matching adjustment above corporate bonds is 75 basis points as at the end of December 2016. So you can see why ERMs are a popular investment, particularly for annuity providers. So who are the investors in ex-release? Well, there are 6 retail annuity providers. Yes, there are only 6. There they are. They're writing premiums of about $4 billion in 2018. And then there are 8 bulk annuity providers who they're estimated to complete around $35 billion in 2018. There are also reinsurers, pension funds, and fund managers are investing in ex-release, and the list of investors is growing in the UK all the time. So I said I was going to mention the regulatory context to the paper. Earlier this year, David Rule from the Bank of England gave a speech entitled "An Annuity is a Very Serious Business." Some of the key points he made were that the Bank of England priority was to ensure that insurers capture the compensation for risks they are exposed to in the fundamental spread, so that the matching adjustment is not overstated and insurers hold appropriate capital against these risks. This would appear to summarise the essence of what the PRA was aiming to achieve through the regulatory changes they were consulting on in CP 1318 and has been confirmed in PS 3118 yesterday. And these aims would not, on the face of it, appear to be unreasonable, but the key question that the ERM Working Party is trying to answer through its research and the independent academic research is to establish what is the correct way to calculate the cost of the risks embedded within ex-release mortgages. And there is also a debate within the profession going on about whether or not the approach proposed by the PRA is too prudent, and hopefully we'll have some discussion on that later on today, or this evening rather. So SS 317 is a supervisory statement published in July 2017 and updated yesterday, and introduced many of the points clarified in CP 1318. Within SS 317 and subsequently in CP 1318, there is the concept of an effective value test, which is used by the PRA to determine if the matching adjustment benefit claimed by a firm is too high. The effective value test has 4 key principles, which when considered in isolation seem perfectly reasonable. The 4 principles are: there is no reduction in risk if the securitized notes are held by the same entity. The economic value of the ERM must be less than the present value of the deferred possession of the property, acting as security for the mortgage, where the present value of deferred possession is the price that would be paid and settled today to take ownership of an asset in the future. The compensation for risks retained must be greater than the best estimate cost of the no negative equity guarantee. The PRA argues that this is consistent with the fundamental spread, allowing for the expected cost of defaults as well as the cost of downgrades. And a rational investor would require compensation above and beyond the average outcome based on their best estimate assumptions. It's important to note that the economic value as referenced in the second principle refers to the green bars in this diagram, where the PRA expect the asset value of restructured ERMs plus the MA benefit to be less than the economic value, and that the economic value is calculated in a way that's consistent with the principles already stated. And now I'll hand over to Charles to talk about the no negative equity guarantee.
Okay, well, Tom's talked about giving you an overview of the market, both from a customer and an investor perspective. And he's also given you some insight into some of the PRA's recent statements. I'm going to look at the no negative equity guarantee, which is one of the sort of key features of equity release mortgages. And I'm going to start with where we are currently. Most firms currently model the no negative equity guarantee using Black-Scholes, using a closed form solution. Black-Scholes, of course, assumes that has an underlying assumption of a geometric Brownian motion, effectively a random walk with drift. And that's one of the sort of key features of Black-Scholes and one of the issues, possibly, in terms of the modelling of the no negative equity guarantee. Effectively, firms model it as a put option and then model decrements deterministically. So you've actually got a sum of all these sort of put options multiplied by a sort of probability of death or moving to long-term care or redemption. Okay? Some firms, and it's a minority, use stochastic models for their valuation. Quite a few firms use stochastic models for validation of the Black-Scholes. So it's not necessarily fair to say Black-Scholes is actually their only thing. They do test whether the Black-Scholes numbers look reasonable in terms of stochastic models. And stochastic models do have advantages, which I'll come on to. Now, academic research, we reviewed quite a lot of literature, and basically the academic research showed various features, and those features don't necessarily fit with a geometric Brownian motion. They showed that house prices exhibit autocorrelation, or serial correlation. So effectively, if you look at different time periods, if you look at a lag, you'll find there's a correlation between house prices over different time periods if there's a lag. And serial correlation is something that you often see in markets where there's sort of seasonality. But here it's more to do with the second bullet point, which is momentum effects. Effectively, if the market's going up, house prices tend to go quite nicely and they can continue to go up. And if the market's going down, they tend to go down as well. And so there's sort of momentum effects. The market also shows mean reversion, so that if you're looking at the sort of average house price inflation, you find that it moves around a long-term average. And that might be a real long-term average, if you like, adjusted for constant prices, rather than necessarily a nominal average. It also is, the market also shows something that is a bit of a tongue twister, conditional heteroscedasticity. And that basically is stochastic volatility. Volatility is not constant, unlike the assumption made in Black-Scholes. And volatility also varies by different types of property groups. So you might have regional house price variations, types of property, so you could have differences between terraced houses and semi-detached houses and detached houses. So volatility is not constant between those different types of things. And one of the more interesting features of the market is a bit like the equity market, if you like. It doesn't necessarily follow a random walk. Sometimes there are discontinuities, there can be jumps. And so if you look at the 2007-2008 financial crisis, the market plummeted quite rapidly. I've got lots of charts, and I don't think actually I've got time to go through them, but very, very quickly. There's annual house price inflation in nominal terms. There's the same thing adjusted for inflation at constant prices, adjusted by RPI. I'll go back and forward. It's on the same scale, so you get a rough idea that actually what you see on one chart is not necessarily the thing you see on the next. But if you look at it, you can sort of almost draw a straight line through where it's going, and that sort of comes back to the sort of mean reversion type argument. The other thing, I think this is a 30-year moving average of real house price inflation, and it's by different regions. The top red line is London, and London has clearly, over long periods of time, has performed a lot better than other parts of the country. The green line at the bottom, which started going up at the end, was Northern Ireland. In recent years, it's been doing quite well in Northern Ireland. Okay. And there are lots of other figures. These are the figures I gave actually at the Life conference recently, and they showed that volatility varies by region. They show that autocorrelation varies by region. And there's also some interesting features if you look at the 10 years since since the credit crisis. Probably a bit too short to actually sort of calibrate your model, but it's interesting. The volatility appears to have gone down, and autocorrelation as well, if you're looking at a one-period lag, seems to have reduced, particularly if looking at annual correlation. There's not much correlation between 1 year and the next, more correlation between 1 quarter and the next. And the final thing we were saying, that in terms of charts, you can see different things in terms of different types of property. I think the blue line's flats, but I could be wrong. It could be houses, detached houses, I don't know. Okay, so what are the issues? And the issues clearly are whether you should be using a stochastic simulation, Monte Carlo approaches, or whether you should be using closed-form solutions. The market at the moment tends to use closed-form solutions, but we did a poll at the Life conference and everybody voted for stochastic simulation for Monte Carlo methods, and thinking that's, you have much more sophistication, which is the next point. You can allow for correlations between different factors. There are issues about how you calibrate and estimate your parameters in a model. And there are lots of different ways of doing it. And if you're using Black-Scholes in the moment, which you make an adjustment for autocorrelation, you change your volatility rate to allow for autocorrelation by doing effectively like a de-smoothing. If you're using other types of models, you don't necessarily need to use de-smoothing because actually they're intrinsic to the model. So, so there are issues about calibration and estimation of parameters, and they may be different for different types of models. There are lots of nice methods that the academics use to calibrate their models. Maximum likelihood, method of moments, generalized methods of moments. I can name 3, and there are probably even more, There's the issue about real world or risk neutral, or whether you could have some sort of halfway house. I mean, clearly if you're trying to model cash flows, then real world, and you're looking at your annuity liabilities, then real world seems quite reasonable. Risk neutral, per se seems reasonable because that's what investment bankers use, and it's a way of doing sort of pricing options. It seems quite reasonable from that point of view, but there are different difficulties because there's no real market in terms of what you're trying to assess. There's also the possibility maybe of a halfway house solution, and maybe that's what we're sort of coming on to in the academic research, but you could allow for, say, mean reversion, you could allow for other things, or autocorrelation in your modeling, and that might be a good idea. There's also the issue about the deferment rate or rental yield assumption. The PRA opined on different things about ways of Sportelli formulae, looking at sort of land tribunal type cases, looking at differences between freehold, leasehold type differentials, looking at rental yields, and those rental yields would have to be adjusted for costs of renting, So there are lots of issues about deferment rate or rental yields and how you actually calibrate those things. I don't think there's any one particular answer, although the PRA have a number. Okay. There's the choice of discount rate. In a risk-neutral basis, then it's clearly a risk-free type assumption, a swap rate if you're looking at currently what we do. But if you're valuing more generally, you could have a stochastic model for interest rates. And so there's a lot more you could do if you're looking at real-world solutions and so on. And there's also the overall consistency of the valuation of the no negative equity guarantee with the overall valuation of the equity release asset. So there are lots of things there are lots of issues. And we sort of looked at what literature had in terms of possible solutions. And there are lots of different things. I mean, I think the most favoured, I've sort of listed some of them here. I don't think I want to go into them in detail now. I haven't got time. But combined models seem to be the sort of favoured approach by academics at the moment. Sort of ARMA-GARCH, ARMA-EGARCH, ARIMA-GARCH, EGARCH, and so on. They also go from effectively a real-world predictive sort of distribution to a way, there's a mathematical way of converting it into a risk-free and arbitrage-free type of no arbitrage solution. And, there's some quite interesting ideas out there in academic papers. There are, I mentioned 2 ways that you could do risk neutralization. There are also issues if you want to go closed form, because closed form clearly has an advantage if you're a regulator. It's a nice, easy thing. If everyone's using a closed form solution that looks very similar, then it's easier to see whether one firm is stronger than another. But closed form solutions, if you're getting to more complicated type of modeling, requires compromise and suitable calibration. But even, what we do at the moment, Black-Scholes, we've already got a compromise in that we up the volatility rate to allow for autocorrelation. So we looked at all this academic literature and we decided, we didn't really know what the solution was. And there are lots of possible solutions out there, and we didn't really come to a conclusion. And so the conclusion we came to is that we needed some independent academic research. And the IFRA, in conjunction with the ABI, has commissioned research. This research is under the oversight of the Actuarial Research Centre, The research is being carried out by the Kent Business School. Professor Radu Tanaru is leading the research. There's a joint ABI-IFRA review group with Professor Johnny Lee as the chair. Johnny has actually written a number of papers on equity release market, as has Professor Radu Tanaru as well. And Radu has been mentioned in some of the PRA papers, if you look. The review group is, as I say, split 50-50 between the ABI and the IFRA. We've already had some interim results. We're expecting a second set of interim results. And the first set has been shared with stakeholders within the IFRA and ABI. And we're hoping to have published results sometime early next year, the final results. But it's a sort of, a lot of work has already been done, but there's still a lot more work to be done. Okay? And so I'll now hand over to Alex, who's going to look at valuation issues.
Thanks, Charles. So I'm going to talk about some general topics in equity release mortgage valuation that we covered in our paper. I think it's fair to say the methodology for valuing ERMs has been in a lot of focus in recent years. And there was the original 2007 Hosty paper that sort of laid the framework for where we are today. In our paper, we've aimed to provide a guide to current market practice, and we've also aimed to stimulate a bit of debate on some topics such as IFRS 17 and Solvency II. Moving on to IFRS 17. The key question under IFRS 17 is an equity release mortgage an insurance contract? So our research and the conversations with practitioners indicate that the current market practice is to treat equity release mortgages as investment contracts. However, the wording of IFRS 17, which I've got up on the slide, can be argued that the no negative equity guarantee is an insurance feature. So if that was the case and equity release mortgages were to be in scope of IFRS 17, then this would be a significant departure from the current market practice. So although we haven't gone as far as to explore how you would value theoretically an equity release mortgage under IFRS 17, we anticipate that it would involve grouping contracts and setting up things like contractual service margin and risk adjustments. So this issue has been picked up by the IASB, and it was one of 25 issues in their recent staff paper, IFRS 17, Concerns and Implementation Challenges. On Solvency II, we've got a long history of regulation, starting pretty much from the beginning of Solvency II itself. And there's been various different letters to CEOs and so on. You can see that as of yesterday, I've added in 2 extra bits onto the slides in red. It can be quite a lot to keep up with, but I think it's fair to say that there's been a continued regulatory focus, especially around points on the matching adjustment and the, as Tom was mentioning earlier, the 4 principles of SS3-17, which has now been kind of solidified into this effective value test in PS 3118. So we actually built a simplified model to run the effective value test. So I've got 2 examples here. Example 1 on the left is a typical 70-year-old customer with 30% LTV, and example 2 on the right is an identical customer with 40% LTV. So there's a few things to draw out. The dotted line represents the notional effective value of the loan, and if the teal neg is too high, then the effective value test fails and the company would not be able to claim that level of matching adjustment. So we can see clearly that although the current market practice of using a real-world technique to value end egg places a much lower value than using the risk-neutral approach set out in the recent PRA guidance. And that's true even for a 0% deferment rate, which the PRA said is the minimum possible deferment rate to use. And it's interesting to see that for the higher end of the LTV market, the amount of matching adjustment claimable, or the maximum amount claimable, is quite significantly lower than for something more in the medium kind of LTV range. So finally, there's a couple of topics I probably would have liked to include in the paper, but just too recently off the press. So there's the published yesterday PS 3118, which has really solidified the effective value test from CP 1318. And it's also signposting to further consultation activity early next year. So I'll probably have to go back and update the last slide again. And yeah, finally, the ISB has proposed to delay IFRS 17 implementation by 1 year. And yeah, potentially this could give the industry more time to engage on actuaries' mortgages and whether or not they could potentially be de-scoped. So I'll now hand over to Raj for structuring.
Fantastic. Thank you, Alex. That walk is getting slower and slower as I get further. Everyone gets further and further away, so good luck, Scott. So, structuring. I guess, where has it come from and why securitize? I mean, if we look to a few years ago, there were very few securitizations in the market. There were publicly the Aviva ERF securitizations, but really, I think everyone is well aware that Solvency II regulations changed the landscape for ERM providers, and the requirement to have fixed cash flows in matching adjustment portfolios meant that a solution was needed. Now, of the rate, securitization is one of the range of options that's available. From the survey that we conducted with various market participants and to the working party's knowledge at the minute, it is the only solution that is actively out there and being used by annuity providers in the UK. So what do they look like in a nutshell? Insurers write the equity release mortgages within their insurance company. They are passed into a securitization structure, or an SPV. That structure issues some notes. So we're going to call them a senior or rated note, or a series of notes, which is bought by the company's matching adjustment portfolio. And then a junior layer, which is typically unrated, which may or may not be held by that firm. There are examples, or is one example where that has been bought by another company outside of that insurer. So we have portfolios of ERMs and we've had them in the market for a long time, and there's lots of discussion around securitization. Why is there so much discussion? Well, the diagram sets out a few of the additional risk implications of having securitization. The dark blue line represents a series of cash flows from a portfolio of equity release mortgages. The gold line is a securitized note, and the two dotted lines represent two different scenarios around which present the potential variability in the cash flows. And what this gives me are two relatively new things, which I didn't explicitly have before. The first is in the scenario where my portfolio is providing less money than my rated note, which I put in the MA portfolio, I need liquidity, and I need money to be able to find money from somewhere that is not my portfolio of mortgages to meet that fixed cash flow requirement. The second is that shortfalls. there I potentially need, I have to save up money now to meet future needs or find money in the event where I'm falling short in the future. And the green line is where I have surpluses emerging in the future. So, different risks. How do firms have, what issues or do firms have to balance against one another? Well, yes, securitization has a series of notes. Yes, they may be of different sizes, and I've talked about liquidity and potential cash traps as well. And most firms are writing new business. Therefore, I need a vehicle that is flexible or in some way allows me to get the benefit from writing new assets into my annuity portfolio in a slicker way as possible. So where is the market today? I think the answer is on every single one of those example dimensions in quite different places. I think that reflects the need for different firms look to optimize different things. Some look at financials, some look at complexity, and cost is also really important because it's clear that it's not cheap to achieve compliance. So, message here is there's no one-size-fits-all solution in the market. I think the other message that we took away from our survey is that this is a regulatory construct and not a market-based construct, which means very different things, and there are advantages to keeping life simple for yourself if you can. So Alex touched on valuation then, and that's the final piece I will touch on. So there are valuation methodologies in place for underlying portfolios, but now I've separated those portfolios into a series of notes and issued them potentially to two different places. So where have firms got to with that valuation? Well, first is the principle of retention of value. I have a portfolio of equity release mortgages. I structure them. I issue something different for my portfolio. I issue some notes from that portfolio of equity release mortgages, and you would hope that what I issue is equal to the sum of its parts. There are learnings to be taken here I will have some rated notes from that securitization. There is a junior note from that securitization as well. And there are issuances in the market, I guess the question really is, which one do I value first? And which one do I try and value first? If I look at the rated notes, we see firms within our survey who look at valuing that first, look at equivalent assets that might look and feel like that rated note. If we look at the junior note, then perhaps looking at something that's more equity-like. I think the one consensus we did get is whilst there are different starting methodologies, most firms then use an alternative approach to try and get to test whether the answer that they've produced is reasonable or not. Valuation in stress on the asset side, typically a mechanical application of the valuation in base. So I won't touch on that any further. Valuation in stress on the liability side. So we've talked about the matching adjustment, the policy statement issued yesterday and the up-to-date date of SS317. I mean, in principle, and I've quoted the SS18 there, that firms can't just consider a mechanistic application, which is of the matching adjustment in stress, which is a mechanistic application in this sense is to revalue the underlying portfolio, revalue the notes, and then re-rate the senior note, the notes from that securitization, and apply my fundamental spread parameters to that calculation. Now, over and above that, there is a requirement in that same supervisory statement to consider the fundamental spread in stress. Within the working party, that will be something that we consider further and will be an area of further research. What I will just dwell on, though, is that what it does place a lot of onus on is rating. It's the quality of the rating and the ability to be able to re-rate the issuances on a frequent basis within capital models. I'll now hand over to Scott, who just talks through some of the approaches taken around rating.
So I'm using old technology and new technology in the same time, so quite good multitasking today. Good evening, ladies and gentlemen. So in the next section, 4 slides, so just letting you know there's only 4, so you know where we are. I'm going to look at, as Raj says, I'm going to look at the approach to assigning internal credit ratings to restructured ERMs. And I'm going to begin by looking at the need for such a rating. And then I'm going to consider the approaches actuaries might wish to take to determine an internal credit rating. So first of all, the rationale. Well, as Raj so kindly gave you an idea for the answer to that, it's there's regulatory requirement. Solvency II. Solvency II requires insurers to assign internal rating to their senior notes of our ERM restructure for the following reasons. Number 1, the internal rating is required for any large or complex exposure. Even if you have an external rating, you still need to do an internal rating. Now, restructured ERMs are likely to be both a large exposure. Typically, the securitizations are in the hundreds of millions. So it's likely to fit into that category. It's also likely to fit into the category of being complex because, as Raj has just talked about, we need to tranche the underlying cash flows of the ERM. We have to apply waterfall payment structures. And we may have to add other structural features like liquidity facilities, contingent reserves, in order to satisfy the matching adjustment criteria. Sorry, eligibility criteria, I mean. And secondly, in order to apply the matching adjustment to our senior notes, which is the whole point, as Raj has just explained, that is why we are doing it, we need to map the internal rating to a credit quality step in order to select the appropriate fundamental spread from that wonderful table published by OPA in the Solvency II Delegated Acts. And finally, the internal rating process can provide evidence to support compliance with the Solvency II principle of prudent person principle, sorry. These principles require the insurer to demonstrate that it can properly identify, measure, monitor, manage, control, and report the asset risks that the firm is exposed to. So the requirement for an internal rating is clear from a regulatory requirement. I believe in the prudent person principle that that's an appropriate thing that with insurance companies handling other people's money that we should know what we're doing and be able to meet those principles. But what is less clear is how an insurer should go about assigning such an internal rating. In the PRA's supervisory statement of SS 317, it stated that the internal rating should lie within a plausible range that could have resulted from a rating given by an external rating agency, or as we've come to know it as ECAI. Pardon the abbreviations, but it's part of the profession. The supervisory statement went on to say that the internal rating should be broadly consistent with the ECAI approach. So given these regulatory requirements, in the next section, I'm going to look at how insurers can demonstrate this broad consistency. So in preparing the paper, we've spoken to ECAIs, namely Fitch and Moody's, to look at how they rate notes issued by ERM securitizations. And our initial discussions led quickly to the following conclusion. There is no single defined approach to rating ERM notes, but wider than that, there's no defined approach to rating any debt instrument, which was a bit disappointing, but there you go. The ECAIs apply different methodologies, assumptions, expert judgment in determining rating decisions. And as a result, you can lead to a different ECAI rating for the same exposure. And this is a common occurrence with corporate debt. You can have one ECAI that will rate your debt single A. You'll have another ECAI that will rate your debt exactly the same debt, triple B. Therefore, what we came to the conclusion was consistency does not mean exactly the same approach or rating as an ECAI. If we're clear on what consistency does not mean, can we be as prescriptive on what a consistent internal approach should look like? And we can make the following observations, as in this slide shows you. First, the analysis should model the underlying asset cash flows of the underlying ERM portfolio under a range of individual and combined stress scenarios. That's a consistent approach. The analysis should also consider the non-market risks. Those are like due diligence of the legal risks, operational risks, regulatory and compliance conduct risks that you're exposed to. And on the other side of securitization, the senior notes that you've produced, you need to be able to analyze their resilience of the structure to meet those debt obligations. And finally, the rating analysis should apply expert judgment in determining that rating decision, taking into consideration the results of your scenarios, but also when you're assigning the weight you're going to place on those results, you need to take into account the plausibility and the materiality of those results. So scenario modeling is an important part of the rating process, and in the next slide, I consider how such scenarios might be derived. So the general observations we made from discussions with ECAIs was, first of all, on the left-hand side of the chart there, we've got the usual letters, AAA, AA, single A, all the way down to single B. Speaking to the ECAIs, it was clear that AAA scenario is designed to cover something they've never seen before. Now, in discussions, that added the question we then asked, well, if you've never seen anything before, how do you bound it? You must have to bound it, or else you could just assume 100% house price fall. You could assume that everybody, all the policyholders, borrowers die tomorrow or prepay. So asking the ECAIs about that, they were clear to say, well, we employ expert judgment as to determine what those bounds are, which comes back to my point, plausibility, the feasibility analysis. The second part was down at the bottom end of the scale was single B. Single B, if you want to know what a best estimate would be, base scenario would be, single B is a good proxy of what that might be. The other points that were raised was that the house price stress scenarios, we go to the actual scenarios, we concluded that the house price stress scenarios that firms should use should be those that are being published by ECAIs. The rationale for that was that the ECAIs, for their ERM ratings, they will actually generally rely on other products that they've already rated that are similar, have similar house price type risk factors like RMBS. So that there's a much greater wealth of experience the ECAIs have on house prices. When it comes to other risk categories like mortality, longevity, morbidity, those are more bespoke and much more related to the specific portfolio that they're rating. So the published indices, the ECAIs made clear that they would seek to utilize data that the client or the insurer had to support their rating scenarios. They were clear in one point was that the data, how much data is material. They did say that the data should cover at least one full economic cycle in order to give them a breadth of depth of data to support their analysis. One thing I just did mention is AAA and the other thing that the ECAIs have told us is that, and this was interesting because this is something I don't think a lot of people have picked up on. AAA and AA, when they rate AAA and AA, they look at the timing and the amount. So you have to pay the amount you promised to pay on the time you said you'd pay it. When you go to single A and triple B, what they're now rating is not the timeliness of the payment, but over the full maturity of the instrument, will you get your money back? Will the debt holder get fully paid? So that was an interesting observation from our conversations with the rating agencies, which I don't think a lot of insurers have fully reflected in how they do their internal rating. It's a subtle but important difference in how a rating agency looks at it, whereas an insurer might look at it under the matching adjustment type world of timeliness as well as amount. But we're trying to be consistent with an ECAI, not with Solvency II. So I'll conclude with one of our other key conclusions, which is that expert judgment plays a fundamental part of an ECAI's rating approach. And importantly for actuaries, I think this is the thing I want to leave you with tonight. Rating decisions are not purely a statistical exercise. The computer will not give you the answer, because if it does, you're not being consistent with an ECAI. The scenarios will inform your decision, but it is not the end of the process. And I would stress that you spend as much time doing your modeling and the same amount of time considering the result. And that will put you in a much more consistent approach to how an ECAI would look at rating ERM, or for that matter, any other debt instrument. So as I said at the beginning, and I'll conclude, consistency does not mean the same.
Sitting to my right.
Do you reckon, Paul? We've got 71 votes.
Let's pause it there, I think. Yes, that's sort of quite split, which is interesting. I was sort of interested to see which way that would come out. We didn't ask this question at the Life conference. I think it was when we added, isn't it? So
yeah.
We were quite intrigued to see what we got. It'd be nice to hear from people who voted either side in the discussion, if we can.
Paul, do you want to move to the next question? Or?
Yes, let's move to the next question, yeah.
Okay. Right, here we go. So the next question is, which modelling technique do you think is more likely to lead to a more accurate estimate of the cost of the no negative equity guarantee?
This one's interesting, I think, in a way one could rephrase the question, which we haven't got the technology to do, so we're not going to. But I think if you rephrased it as which modelling technique do you actually think you have the resources to do in order to get to the cost of the no negative guarantee? Because I think one of the fascinating things that came out of the Life conference was we got a very similar, in fact, if anything more, I think, strong response towards stochastic simulation, and yet the survey done of what people actually do tells us almost no one does stochastic simulation. So there's clearly a mismatch between the theory and the practicality here, I think, which again, something would be interesting if people want to pick up on it in the discussion. Should we be using more complex techniques, or, is Black-Scholes good enough?
Then move on to the next one. So do you think ERM should be accounted for as an insurance contract or investment contract, or both? About the same number.
Yeah, let's close that one. That's interesting. Investment's about 50, but it's not overwhelming for investment.
No.
The level of risk, I think, is an interesting one, because actually, it probably fits the standard, but on the other hand, accounting for different equity release mortgages differently, I suspect itself creates a lot more problems than it solves.
Okay.
Is that a final question, or do we have one more?
We've got, so hopefully you can see.
This is one I think we're interested in priority for further research. It's worth saying what we don't have on here is how to value equity release mortgages, because that is the current research that's being done by Professor Tenaru.
And obviously, Edda, you'll have to explain that to us in person. Going.
Do I I find it slightly depressing from a customer perspective that product innovation comes out so low. I haven't voted as chair, but I would have clicked that one.
Okay, and then probably almost controversial one. Do you think SS317 and PS3118 leads to an appropriate level of prudence?
Again, if anyone who voted on either side wished to at least contribute as to why, that would be interesting. I wish I had the technology to make a spotlight, randomly pick a person who voted. I could pretend I have got that technology and just point to people, but...
Yes. Anyone keep going?
Interesting, given the share price reaction. That seemed quite favourable. That was probably because of the, I mean, again, especially we're talking about the treatment of back books versus treatment of liabilities going forward here in a way, but in some ways the industry seemed reasonably happy with what came out. Or at least their shareholders do.
And that's it, Paul.
Okay, thank you for that. That's a new thing we've tried. So I think we probably do have feedback. It would be interesting to get feedback from people afterwards in the feedback survey as to if they think that's a useful innovation for sessional meetings or not, whether that adds to the discussion or detracts from it. So I will open the floor to contributions. Feel free, I mean, it's nice to have thoughts, but feel free to ask questions as well. We can make this interactive, so don't feel that you have to be a subject matter expert to say something. I would welcome the first contribution, at least from the one volunteer that we had.
Hello? Okay. Katie Hicks. I did my dissertation on whether house prices in the UK have a unit route. So for those who don't remember from CT6, that's whether they have a random walk if you take the first difference of if it's an AR1, and that is what I found, that it was an AR1. Now, it wasn't entirely conclusive, but it was fairly clear, and also my diagrams look slightly different from yours, and I used nationwide quarterly house prices. I saw you use nationwide. There is quite a lot of research on regional differences, and I didn't look into that. However, the academic research I looked into on the UK in general, a couple of sources just stated that the house prices do have have a unit rate, one unit rate. So that was almost taken for granted. So it's just interesting to see slightly different results, and I'd be interested to ask later or see in the report what was different in your methodology.
So we want to pick up now? Anyone on the...
Well, I think it wasn't really our methodology, it was methodology in various academic and professional papers, and so we were looking at that. And so if you like, that's what we've reported. And primarily in the UK, but some of the papers were on overseas markets as well. So there are lots of interesting things in there. And so it's academic research, not our research. And we sort of decided, having looked at it, that actually we needed some academics to help us out. Okay.
Have one over as far away from you as you can get.
Thank you. Sean Lazari, Legal and General. In the survey of academic research that you looked at, did you find any research that agreed with the apparent view of 50% of the people in this room that using very basic kind of risk-neutral valuation approach with normal distributions underlying it, that sort of thing, is prudent?
I don't think we really found that. I mean, I think there There are some papers that suggested that Black Scholes that might be an appropriate methodology, but most papers go for much more complicated models, and
Yeah,
not necessarily closed form solutions. Actually, lots of them don't have closed form solutions. Which, if you were a regulator, I think you actually might prefer a closed form solution. So everyone's saying they wanted Monte Carlo modelling, stochastic modelling. As a regulator, you like something to benchmark people by, and stochastic, everyone will do their own thing, won't they? And it's be very, very difficult to compare one firm against another. So I can see benefits of closed form solutions, which the audience doesn't necessarily see. Okay.
Yeah, I note in the paper you say that we should take a step back and kind of think about adding in all these extra features that you can with stochastic models.
but then also look at whether we can actually, if you like, still use Black Scholes with suitable calibration. You know?
Indeed.
So we want to look at the ideal and then say, well, actually, from a practical point of view, is there something else that we really need? Can we still use Black Scholes? And if so, how do you actually calibrate it? Because we make adjustments at the moment, as I said in my little 5-10 minute speech. We make adjustments for water correlation at the moment. We de-smooth. House prices are actual real sold house prices in the nationwide index. They're not like commercial properties, but they clearly do. There's a lot of correlation from one period to the next. People, when they decide on their house price, get their estate agent who tells them, based on these sort of representative properties. And so there's,
I guess my concern is the thing that flashes red for me is that any of these kind of additional features that you add into a model, like
the point is that the additional features give better fit. I think that's what's coming out.
Well, there's no data to fit. If you add in fat tails,
I don't want to preempt the academic research because I've seen the interim paper. But effectively we're looking at the sort of the best fit in terms of models, and geometric Brownian motion, let's give it its proper name rather than Black Scholes, doesn't necessarily give the best fit.
Indeed,
and it doesn't necessarily, if you're sort of trying to project forward, or even back test if you like, but I think it's more projecting forward. It doesn't necessarily fit the bill, okay? And so other models are better, but can you still use something else?
Yeah, okay. The point I'm making is I would imagine that any more refined, sophisticated model based on risk-neutral principles is going to increase the value of these options. And given everyone thinks currently...
You see, I don't necessarily think that's the case, because if you look at Black Scholes, it assumes constant volatility. And, Black Scholes square root of time, volatility over a long period will be based on square root of time. And if there's mean reversion, the volatility, using a constant volatility, could under or overestimate depending on time period, So I think you've got to be careful about thinking that Black Scholes gives you the correct answer, because it might give you an answer in the midpoint.
No, I definitely believe it doesn't.
Not give it on
both, I think the real answer is a lot higher.
And long. You could be either under or overvaluing using Black Scholes, and the whole point is we're trying to get something that fits house prices better.
A couple of contributions here. We'll come to you. Well, go there. Yes. Sorry, didn't see you. Apologies. We'll come back to you. And then we've got one over here as well.
Marcus Barnard from Unis Securities. Just a couple of thoughts. I think the policy statement yesterday talked about using reviewing deferment rates and looking at these relative to real yields, and it did sort of, it's something I've been thinking about a bit, because that gap R minus D is something that does appear in the stochastic model that's in in the Black Scholes model that's in CP 1318. And just thinking about this in a real world analogy, if you were looking at an equity that had a very high yield, you'd probably expect no dividend growth from it, and you'd maybe expect not to have much left of it after a few years. Whereas if you looked at a stock which had a very, very low dividend yield, you'd be buying it on the anticipation of growth. And I think that's sort of relevant in thinking about the NNEG, that, if you are buying crappy old properties with high yields, then you're going to expect to lose money on them. And if you're buying something with a very low yield with expected growth, you should expect to make money. I'm just interested if you had thoughts on that.
Any thoughts?
Well, I think if you actually look at the data, some of what you say may be true, but not necessarily as much as you think. So if you're actually looking at some regions, some rental yields might be quite high, and the growth necessarily hasn't been impaired that much, you know. So, and that's one of the issues for the academic research, if you like, you know, because I'm not going to give an answer to that one. But it's not necessarily clear.
So there's one behind the previous speaker, and then we'll come back to
I've got a question in relation to credit rating, and actually one is maybe a question, one is an invitation to discuss. Firstly, the rating agencies generally have a timely payment of interest and ultimate payment of principal in structured finance world. I think by doing this, the AAA and AA, I think what you suggested is the most senior, typical most senior rated tranche. So that's why they go for a timeliness of payment on interest. But their pass-through rating is always ultimate payment of principal. They're extremely uncomfortable to moving away from that timely ultimate payment of principal concept because we ask them basically rating liquidity, and that's just uncomfortable for them. So when it comes in our conversation with the agencies to try to get them into this timely payment of principal conversation, they are getting into this expert judgment kind of credit committee panels where they actually discuss how did we calibrate properly the stresses around timing of cash flows, which is prepayment and recovery speed or everything that's not really credit in a pass-through context. And our experience is that they are getting really extremely conservative, and at that point in time, the rating exercise typically falls over because it comes to very difficult rating that doesn't make economically sense anymore. So I think I am a bit worried that if we now suddenly become all these experts in-house across all the insurers, what is the level playing field and who will be judging what is the right level of these calibrations if the agencies themselves are uncomfortable? And my second point is when you mentioned that on the junior note, though, there is a deferral allowed, which again, in the context of a mezzanine note to junior note, that's their normal practice. And you said that we comply with rating agencies rather than MA requirements. Does it mean that would you be happy to put that bond into your annuity portfolio and allowing an extension of the notes rather than a default, which is technically, I think, the requirement under the MA? Thank you.
So can I take your name as well? Can you just mention your name for the record, please?
Sorry, it's Zoltán Gallio from Scottish Widows.
Thank you. Do we want to respond to that?
Yeah. Apologies, I may not have captured all of that. But I think to answer on the junior note, or the MES, because the junior note I think of as equity piece, but the MES piece, I think it goes across to the consistency with corporate bonds, because single A or triple B, the corporate bond is in a matching adjustment portfolio. And what we're just finding, what the guys are saying is that when we look at that rating, it's the timeliness of the payment is important, but it's not fundamental to getting that rating. It's about getting paid. I think insurers should take that into account in terms of the rating, in terms of their internal rating, and if they're comfortable with that risk, it applies not, as I said, it does applies more across. I think ERM and rating, to apply, just look at ERM on its own, I think is unfair. Rating is across all debt instruments. I think on the AAA, what we found is there is a wide dispersion of views about what you think a AAA scenario is. No one, I think rating is an opinion, it's not a fact, and you can compare, I guess, with the published methodologies. You can look in comparison. You've also got, as Raj was saying, we've got some securitized notes that are rated that highly, and I think it's difficult for one insurance company to look at another insurance company and say, we're different. You're AA, we're AAA. Oh, that means you must be wrong. I think, as shown with the split ratings you find on a normal corporate bond, single A, triple B, one letter difference is not unusual. It's not unusual in the corporate bond market. And I think what we were looking to see is there consistent approaches, not just with equity release mortgages, but can that approach be applied to all assets, either in a matching adjustment or not even, or to that matter, forget matching adjustment, just in principle, right across any insurance company's portfolio, whether it be in a matching adjustment portfolio or a non-matching adjustment portfolio, that approach. And what we found was that, yes, you can be different. So your experiences might be different from my experiences or somebody else in the panel's experiences. What we're saying is being different is not wrong. It's not wrong. And the danger we have from a regulation that says that if you differ from me, then you're somehow wrong, means that there would be a herd mentality. And that's what I'm concerned about.
So could you just wait for the microphone for a second, otherwise we might struggle to hear you. Thanks.
I fully agree. This is all a rating opinion. Absolutely, this is an opinion. I think they are regulated anyway, and they can't state otherwise themselves. The point is, though, all the insurers will be, all of them motivated to be the most aggressive on the rating, because that will have an economic impact and driving the market share in the ERM business and profitability. So there is, I mean, who will make sure that there is kind of a level playing field? Again, it just comes back, because whoever takes the most aggressive view will be the most successful in the business potentially.
That was a statement, not a question.
Okay, I think we had a question at the front. We've been waiting a while, if I may.
Questions, just to the panels. Obviously, there has been a lot of debate about what sort of modeling, what approaches that you should use to model LTM and NAC. I just want to ask, has there been any studies that give some order of materialities in terms of model risk and basis risk are we contending ourselves with in deciding modeling LTM and NAC? And are you, the panels, seeing some convergence in terms of market practitioners and the regulators coming to some consensus as how we should really evaluate this instrument?
I think, sorry. Go on. Yeah, I think what we've seen in the survey is actually a very wide range of different market practices for valuing ERMs. And that goes for Solvency II as well as IFRS. So you can see that one of the PRA's main concerns in implementing the effective value test was to try and achieve more consistency, especially across internal ratings and matching adjustment. But I think that's why we really want this research to happen, is that we want to help provide some kind of thought leadership and continuing to develop actuarial knowledge on how to value the NEG, and just sort of, I think gradually, since ERMs are a relatively new product and we don't have the same kind of history that we've got with annuities and term insurance, for example, I think that gradually we will see more and more convergence as the ERM becomes a more mature product and more and more thoughts and opinions get added to the professional debate.
Yeah, I think just to add to some of the survey observations, I think whilst there's limited convergence in the valuation methodology that is used, I think we probably have seen and observed since the structuring points have become, structuring has become an issue for firms, and there's been an element of fixity introduced to cash flows, the increased need for validation, and trying to use or looking to use alternative approaches, because as I mentioned on the slide, there are different risks in there that do crystallize and come to light, and therefore for some firms who potentially are using a deterministic model for particular uses, whether it be valuation, whether it be for rating, are also thinking about a stochastic model to test the overall appropriateness of that, and using a range of solutions rather than a single solution to come up with their valuation of potentially the asset, potentially the neg, potentially the matching adjustment, or even the rating. But there's no synergy at the moment in the use of different techniques across each of those components.
Can we have the microphone down the front? Because we had a couple of people had their hands up. So do you want, thank you for your patience. It's been a while getting the microphone to you.
My name's David Land. I guess I was surprised that you were arguing about the differences between option modelling when you haven't yet fixed the right method of calculating the forward. That seemed like a pretty major source of possible error. And I don't really understand why there's much dispute about what the forward should be. I guess it's an interview question that I've asked for 20 odd years, is how do you calculate the price of a house that you want to exchange the money for in a year's time? And the candidates who get the job are the ones who understand that it's the difference between the financing rate for the house and the rental yield on the house. And the candidates who don't get the job are the ones who think it's got something to do with what house prices are going to do over the intervening year. And yet, the people here, half of them seem to think it's a good idea to think about what house prices are going to do over the period of the option. And I wondered if somebody can help me understand that.
Who wants to take that curveball? It is a very valid curveball, and I'm surprised it hasn't come up before in the discussion, so thank you for raising that. None of the above?
I'll make one observation. It depends what you're using, the modelling for. So if you're trying to model cash flows and you've got annuity liabilities and you're trying to model your cash flows, then some sort of option pricing isn't necessarily what you want. You actually want to project forward what actually is going to occur from your mortgages, how they're going to be redeemed, and what the sort of no negative equity cost will be. So you have to do that under various scenarios, but it's more of a sort of cash flow type thing. It's not an option pricing thing. So I'm not sure it's totally answering what you're saying, and I mean, I can see, what you're saying. I was hoping someone else would answer those sort of questions.
No, I think the debate has been around whether or not option pricing for the cash flow modelling is what you should be using. So that's the debate that we've been having.
Yeah, and I think there's another thing about option pricing. Investment bankers have not typically been valuing sort of 30-year options, which they could be on these things, And so we're trying to extend, if you like, extrapolate something that's been investment bankers have used for shorter-term options into something that's long-term. And is that right?
I don't disagree that it's I don't disagree that it's difficult to come up with an actual number, and that there's a large range of possible funding rates that you could think about. So I think that the PRA thinks you can probably fund a house at LIBOR flat, which seems that seems remarkably difficult.
You can sort of see why people are concerned about some of these things, because if you're using
some sort of estimate of long-term rental yields is also very difficult to come up with.
But also, if you're looking at sort of Black-Scholes and you've got you're using a risk-free rate and you're assuming some sort of constant rental yield. Current risk-free rates are maybe artificially low, because of quantitative easing and things like that. And so you've effectively got that put options pretty much in the money, And there's a question about whether that's right or wrong. But so there are lots of issues, and I agree with you. I don't know the answer.
It's certainly interesting. I think the Working Party probably haven't had a chance to digest it in full because it came out yesterday. But there's quite a debate, I think, in the PRA paper. I think a lot of people made comments to the PRA about the cost of funding. Is it really, as you say, risk-free? It's not even LIBOR flat. It's technically LIBOR minus a credit risk adjustment, so it's SONIA flat, I suppose. Whether the matching adjustment is a real-world calculation. People made the analogy to corporate bonds, and if we valued corporate bonds market consistently, would knock off the CDS spread. Again, that would be a fairly obvious question to ask one of your interview candidates, but that's not the way the matching adjustment works. Now, to be fair, the PRA, in their paper, gave quite robust pushbacks on those pushbacks. So I think that's something that I think as a profession and as a working party, well, not personally on the working party, but I think digesting what's in there and maybe thinking about that and feeding that into the academic research that's being done, hopefully will leave us in a better place, but they're all very valid points.
We have passed a copy of the PRA's latest papers to the academic, so
but it's definitely worth it. People haven't read it, it's definitely worth it.
He's definitely going to look at those, although he has parameters in terms of what the research should cover. It doesn't necessarily cover everything that the PRA talks about, because that's not what we've commissioned him to do.
But if people haven't read it, I said the PRA paper is definitely worth a read. Not so much the end, well, the end outcome's interesting, but the rationale for where they got there, I think, does raise a lot of these issues and debate the points in a way that I think is worthy of reflection and maybe challenge, maybe acceptance. But I think it's a very valid contribution to the debate. I had one question, sorry, behind.
Gaurang Mehta here. Let's say this whole idea about internal securitization and PRA or any regulator having problem of making sure that the approach is consistently applied. Would it not solve the problem by requiring all the firms not to use internal securitization to avoid biases or repeated expert judgment application, rather than requiring everybody to use external securitization to transfer the risk in a market-driven manner that will solve the race for getting the good rating on senior notes and junior notes and getting more matching adjustment?
So I think this one's probably for me. So I completely see that. I think part of it is driven by. So I start with: is internal securitization the only solution that's available? No. Can firms, if there is a solution available in the market and the right solution available in the market, could they use that and bring the notes back into the matching adjustment portfolio? Absolutely. I think at this stage in time, maybe it's because we're early on the journey. Maybe it's because the solutions aren't quite there yet. They're not prevalent in the market today. Would that solve all of the issues? I think then it probably comes down to firm specifics, doesn't it? About A, the economics, B, some of the potential issues around transferring these assets to someone else in some way, shape or form, which will give rise to its own issues as well if you were to use some external securitization. And actually, as I mentioned, the purpose of what they are trying to achieve here, which is not access to capital markets like you are with other securitization vehicles, but really achieving a regulatory construct. So absolutely, it's not off the table. Absolutely, there is potential for there to be a viable option there. I think we're just saying the journey we're on now, which is 2 years down the line, the market's just not there yet.
It was done. It was done because there are external securitizations of ERM, but those were done at a time. I think to the earlier point the gentleman raised, in a private market, when you're buying private assets, be it ERM or anything else, you can have all the theory in the world, but it's like when you buy a house, I don't look at my LIBOR curve and work out the option price. You want it, and if you don't get it, then there might not be anything else. You have to take the opportunity cost risk of what else are you going to invest in. I think for external securitization, they were originally done for much short people who they wanted to give them money for 5 years and get it back in 5 years. It was like a usual 7-year with 5-year call kind of structure. And that didn't work very well in a crisis because you've got a mismatch between your duration of what the investor wants and what the asset can provide. And I think from the insurance industry, we are long-term patient investors. We have long-term liabilities, and therefore we have patience and want to invest. So external securitization, risk transfer, you have to find the right audience. And as Raj said, that audience is quite small, and it tends to be, well, you tend to look in the mirror actually and you see yourself. That's the audience. And that's why I think, as we showed in the video, equity release helps people. It's a way of an insurance company who has long-term, can look over the long term to provide long-term financing. I certainly think external securitization, it could catch on. I think that there are quite numerous hurdles in terms, and I don't think just by creating an ECAI, you're just passing from one expert judgment to another expert judgment. That doesn't solve, it won't solve the fundamental question of what do you think is going to happen in the future, like the gentleman said, what's going to happen in the future. It'll always be expert judgment, so you just outsource it to somebody else. But as we said, you still have to do your own internal analysis. So I think the market is not there, but I think with any evolution, it could move on, but it would require a step change in other investors, not insurance companies, but other investors, sovereign wealth, hedge funds, etc., to say to their clients, I'm going to put your money away for 20 years and develop that market. The RMBS market that grew up before the crisis was not funded by people who wanted to put their money away for 20 years. They looked at that as almost like a deposit account. They were looking at 1-2 year notes and getting the money back. So that's why that market actually was so successful, because it's just a vast universe of people all around the world who said, oh, I'll put my money in that for a couple of years, and it's very liquid. They treated it before the financial crisis as if it were a bank account. That's why the interest rate on those instruments just dropped to, well, virtually LIBOR flat. Equity release is a long-term illiquid asset because of the video kind of proves it, that man will be alive for hopefully many, many years, and therefore you can, to liquidate that, that's not an option. So you need to seek, like any market, you need to find a market that brings investors and borrowers together. And that is certainly, I believe, somewhere that can grow, but it's going to be a long road, I think. That's my personal opinion. But.
Yeah, I think it's quite interesting to think about with the new regulation published yesterday, and if the general view of the 52% actuaries in the room is that it's more prudent than perhaps other regulation elsewhere, then certainly something that we could see more of in future is kind of offshoring or regulatory arbitrage, if you like, where counterparties who are not regulated by the PRA would take on this risk from insurers, perhaps who are. So, although there doesn't seem to be a lot, or certainly if we didn't find a lot of examples of this in our research and our conversations, it's certainly something that is interesting to think about for the future.
I think I will end the discussion there because we're getting very close to 7 o'clock. So thank you very much for all of your contributions. Apologies for those of you we didn't get around to. There are also 1 or 2 questions that were submitted on the online poll. So maybe the Working Party can, well, actually they were anonymous questions. So if anyone who wants to own up to those questions and ask the Working Party afterwards, feel free. Apologies for those who didn't get time to contribute. Just a reminder again that a couple of things. This is an interim paper, so it will be revised. So watch out for the final paper. And also, hopefully February-ish, we will have another event to present the results of the academic research that's been commissioned. And I think that may well be the place to debate some of the questions that have been raised as well on sort of some of the more fundamental aspects of valuing NEG, which is the specific focus of that research. And again, for any of you, I think it's probably unlikely, but if anyone prepared any sort of written remarks tonight, please hand them in. And if anyone didn't say their name when they spoke, it might be useful to let people know who you were, so you have the chance to correct your notes before they're published in the BAJ. But thank you all for attending tonight. And I'd like to express my thanks now, all of us in the room, to the Working Party for their efforts and for their ongoing research. So thank you very much to the Working Party.